Dear shareholders, welcome to the General Annual Meeting of Apple Inc. Here's our team who have worked on the proposal, and here's what we are going to present today. Apple is a global tech company that specializes in consumer electronics, computer software, and online services. It serves many consumers, businesses, education, and many others.
First, let's have a look at the financial statement. We can notice the constant increase in Apple's market capitalization, which leads us to believe that the company has grown a lot over the recent years. Market-to-book ratio sharply increased over years. It shows that investors believe that Apple has great future prospects. Book value of equity fluctuated but lowered over the years. It is the consequence of the fact that Apple has been repurchasing shares of its stock. EBIT for Apple in 2021 was significantly higher than in previous years, while EBIT margin remained stable and on the high level. EBIT interest cover ratio appears to be very high, which leads us to believe that Apple makes enough profits available to service its debt.
And now moving on to projections. Looking at Apple's data from 2018 to 2021, we can see a positive growth trend, and here are some statistics to quantify their recent growth. Generally, due to the growing information and technology market and Apple's rapid expansion, we predict 2022 on average to continue in the same trend. Here are more specific forecasts for 2022, and from the graph we can see in 2020 there is a slightly higher growth rate due to higher prices of the iPhone 12 and the pushing of premium models such as the Pro and Pro Max. However, the extent of profit margin growth can be debated, as the expectation of 5G iPhones put more pressure on profits, as 5G components are more expensive. In terms of Apple's future initiatives, they plan to venture into the automobile market, aiming to launch a self-driving electric vehicle within the next 4 years by 2025. This is supporting the increase in Apple's stock price, as it signals Apple's future expansion and likely increased profits. This further backs our estimation that Apple's capital expenditure is also likely to increase, as well as a positive growth in current liabilities and assets, and continued growth in earnings per share, indicating the future profitability and greater perceived value of the company.
As you can see here, Apple's free cash flows appear to be very large. The company uses them mostly to repurchase shares, make acquisitions, and reduce debt. We have actually multiplied Apple's estimated average revenue for 2022 by their free cash flow margin for 2021, which actually gave us the free cash flow estimate for 2022, and the obtained figure, as you can see here, turned out to be very large.
So Apple has a beta value of 1.21. This positive value means that it will move in the same direction as the market. It also has a relatively high beta value, which is often associated with higher volatility. However, with this higher risk and volatility, it also means that there might be a higher reward. Expected return looks at the value of return on a financial investment. You can calculate it by doing the risk-free rate plus the market risk premium minus risk-free rate multiplied by beta. We found that using this equation, Apple has an expected return of 17%.
Starting our discussion of capital structure, we can see from both graphs how Apple has maintained significantly higher issuances of debt compared to equity over the years. The company's debt issuances are primarily triggered by Apple's financing of its capital return program, where the company returns cash to shareholders through annual dividend growth and share repurchase programs, combined with low interest rates they take advantage of in debt markets. By virtue of this, we can see that Apple's long-term debt owed is on the rise, more than doubling here. But to really understand Apple's capital structure, we focus on net debt and find that Apple's net debt to equity ratio has been consistently negative, meaning that despite long-term debt increase, the company holds significantly more cash than debt.
The weighted average cost of capital (WACC) is a method of calculating a firm's cost of capital in which each capital category is weighted proportionally. WACC is calculated with the following variables. E is the firm's equity market value, D is the firm's debt market value, RE is the cost of equity, RD is the cost of debt, and TC is the corporate tax rate. Apple's debt strategy helps the business retain a lower WACC than competitors like Google, which has a WACC of 7.5%, thanks in part to the related tax shield with free cash flows more than sufficient to pay the debt. Suppose if Apple's debt is is downgraded, it means it will issue a riskier debt, which needs to be compensated by paying higher yields to investors. This would increase the cost of debt and raise WACC, which could be a signal of higher risk associated with Apple's operations.
Having explored WACC, we highlight that there are market risks underlying Apple. These risks can affect the company by increasing its cost of capital, primarily through their impact on cost of equity. Since Apple has a high beta of 1.21, it has to compensate its equity investors for the risk they take on with a higher expected return.
To calculate the fundamental value of Apple shares, we deducted the sum of liabilities from the sum of assets and divided the number obtained by the number of shares outstanding. The value is very low as asset-based valuation does not include any growth prospects. However, based on our calculation and what we know about the company, we can say that even if Apple stock is overvalued, it is still a great buy as the price is estimated to grow further in the coming years.
5 proposals were put forward at the 2021 AGM. The first proposal looked at the election of directors. We were in agreement with each of the directors elected. This is because of their expertise within the industry, and therefore we voted for. The second proposal looked at reappointing EY as the independent registered accounting firm and as auditors. This is to help control and stay in control of Apple's finances. Our vote was therefore for. The third proposal was the approval of executive compensation program designed to reward performance, which we also voted for as we feel that it is an important aspect of a company.
In Proposal 4, the shareholders asked to amend the proxy access in order to increase nominations. However, the board was against this. We also vote against this as it poses a risk to shareholder value and the company as a whole. In Proposal 5, the shareholders recommend to improve the executive compensation program to include NEO's pay ratios. However, the board was also against this. We also vote against this on the account that the board claims to incorporate an environmental, social and governance modifier into the cash incentive program, which should help to provide additional compensation.
Following from the AGM, we make our own proposal regarding capital structure. Given the trade-off theory, the present value of financial distress is first considered. There are 3 important factors to consider as shown. First, the probability of financial distress. The amount of liabilities relative to assets has increased for Apple. Typically, this increases probability of distress. However, for Apple, net debt has remained negative, so unless there's a shock to Apple's cash flows and asset values, it is unlikely to find itself in financial distress. Second, magnitude of costs after a firm is in distress. Even if Apple finds itself in unlikely distress, the company is likely to have very low cost of financial distress given its ownership of marketable securities that can be sold and liquidated relatively easily, as well as brands and patents it could sell. Third, the appropriate discount rate for distress costs. Apple's high beta of 1.21 gives a discount rate for distress costs of negative 1.21. We note that the present value of distress costs is higher for higher beta firm because it sees its value fluctuating with the market. So if it hits a crisis, this will be together with other firms in the wider market, potentially making it a bit harder for Apple to sell their assets then. But overall, Apple has very low levels of debt and 0 to low probability of default. So no matter how large the potential cost of distress are and what the discount rate is, the probability of distress will be low for Apple and less relevant to our consideration. We also look at the present value of the tax savings from debt. We can see that Apple's interest expenses are lower than interest income, signaling that Apple's debt is too low for the firm to be reaping the full benefits of the tax shield. Therefore, we can conclude that Apple has the capacity to take on more debt and spend more cash efficiently.
The weighted average. For Apple, we propose 4 choices to help you using extra cash more efficiently. First of all, increasing capital expenditures or investment can increase Apple's revenue and reduce the extra cash thanks to the annual depreciation expense. Paying cash dividends can reduce retained earnings and cash balance and allows Apple to share its profit with shareholders. Focusing on acquisitions, the acquirer's cash reserves will be depleted, and there are lots of advantages for Apple as business growth, synergies, domination of the technology sector, and finally stock buyback, which has a great impact on cash flow, earnings per share, cash flow per share. Share repurchases can boost an investor's portfolio too.
Taking into account our proposal, we also have to consider risks that come with it. Increasing capital expenditures or investments may lead to some serious fluctuations of the company's cash flows. Paying cash dividends, in turn, could cause Apple's share price to drop, and focusing on acquisitions may lead to antitrust issues and even some costly lawsuits. Moreover, stock buyback can cause excess leverage on Apple's balance sheet.
How can we countermine the risks? Well, Apple needs to consider market expectations while planning capex, balance cash dividends with stock buyback, engage in joint ventures or strategic alliances, and align any stock buyback with the long-term strategy. Finally, we quickly discuss an assumption that our proposal is sensitive to. We made our proposal on the basis that Apple has a negative net debt, where the cash figure used in the calculation included current marketable securities. In principle, the most accurate way to integrate marketable securities would be to discount them and treat like cash, but because of how highly liquid they are for Apple, with short maturities, we just treated them like cash directly. So essentially, the sensitivity comes up in that given that Apple holds a very large amount of marketable securities, there may be a risk that they turn out harder to sell, especially in times of distress, and convert to cash, than we anticipated when treating them like cash and making a proposal based on that. Thank you very much for watching.